Hello fellow intelligent investors, my name is René Sellmann, and in this video I want to discuss the future of bear markets and whether bear markets will have a different dynamic going forward. I think we've all experienced it during the wild market ride in 2020. We saw the fastest 30% sell-off ever, as it took the S&P only 22 trading days to fall 30% from its previous high. The pace of this price drop even exceeded the pace of declines during the Great Depression. And the stock market recovered just as quickly. So, did the nature of bear markets fundamentally change, and will bear markets have a different characteristic in the future? Do social media platforms have the effect that markets drop faster and recover more quickly? I will discuss these questions in this video, so without further ado, let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Sellmann, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, so if the premise of this video is to discuss whether the nature of bear markets is changing, we obviously should start the video by defining the term bear market. Well, according to Investopedia, a bear market is when a market experiences prolonged price declines. It typically describes a condition in which securities prices fall 20% or more from recent highs, amid widespread pessimism and negative investor sentiment. And I think this definition is a great start. But if I had to pin it down to a few characteristics of bear markets, I would come up with 3 features. Firstly, to qualify as a bear market, stocks need to decline by 20% or more from a previous high. And this is measured by looking at broad market indices like the S&P 500 or maybe the Dow Jones Industrial Average. Then, a second feature of bear markets is that there is an incredibly negative sentiment. Sentiment is simply a measure of emotion in the markets. So when there's a negative sentiment, many investors are panicking, selling positions regardless of the fundamental value. And investors are rather pessimistic about the future value of stocks and the condition of the economy. Now there's also a way to quantify investors' sentiment. There are in fact lots of different so-called sentiment indicators. And these indicators are designed to measure and represent how investors feel about the market and maybe the economy as a whole. The most well-known sentiment indicators are probably the Volatility Index VIX, the CNN Money, Greed and Fear Index, which takes into account 7 different factors to determine how much fear and greed there is in the market. And finally, there are also newer sentiment indicators that attempt to extract information about investors' mood from social media platforms, from blogs and newspaper articles. For instance, analysts may focus on Twitter and come up with a sentiment score by feeding their algorithms tweets about stocks and market indices. Alright, a third characteristic of bear markets is that the general economy is usually struggling a little bit. As you all know, over the long run, the price of a stock will reflect the true worth of the underlying business. So this means that the value of many publicly traded companies is strongly linked to the economy itself. And obviously, if the economy is weak, if consumer spending goes down, many businesses will also be affected by this and are likely unable to grow profits at a rate they grew at previously. Maybe profits even go down. And thus it only makes sense that an economic recession, at least to some extent, should be reflected in stock prices. However, the price declines are usually much steeper than may be necessary to reflect the deterioration of business value or business outlook. Also, what I would like to point out here is that not every bear market is accompanied by an economic downturn, but most are. Now, depending on which source you look at, there might actually be a fourth characteristic of bear markets. According to some textbooks, another characteristic of a bear market is its duration. In the Investopedia definition that I just showed you at the beginning of the video, for instance, a bear market was defined as a market that experiences prolonged price declines. And other sources are even more specific and claim that a decline of 20% or more occurs over a sustained period of time and typically 2 months or more. Historically, the average length of a bear market is 289 days, or about 9.6 months. And I would say this brings us to the actual topic of this video. If a prolonged duration of falling prices is another feature of bear markets, are bear markets dynamics changing right now? Because as I pointed out in the beginning of the video, the bear market investors experienced in early 2020 was the fastest bear market in history, as it only took the market 16 days to drop 20% from its previous high, topping the previous record from 1929. And it took the S&P 500 only 22 trading days to fall 30%. That's not even a month. So again, I just said that the average length of a bear market historically is about 9.6 months. During my research for this video, I found the following beautiful visualization on Investopedia. It shows the average length of historical S&P 500 bear markets in months in purple. And you can immediately spot that the 2020 bear market stands out. What this bar chart also shows is that bear markets come in all shapes and sizes and vary in duration, depth and recovery time. And the uniqueness of the 2020 bear market in terms of recovery time, depth and duration can also be seen in this Invesco graph that I found. And what followed the shortest bear market in S&P 500 history was the quickest market recovery in history. The S&P 500 reached a new high only around 100 trading days after hitting its low or bottom in late March. And what you need to keep in mind here is that the market did not just drop 20%, from peak to trough. Investors experienced a 34% decline. And according to a Reuters report that I came across, if you consider the 100-day period following the market bottom on March 23rd in 2020, then the S&P 500's gains have been the largest in 87 years of market history if you consider that 100-day period following a market bottom. And keep in mind that the average bear market recovery takes 22 months, so the speed of the recovery was also quite remarkable, especially if we consider the following chart that Ben Carlson shared on his website, and that shows how long it usually takes investors to make their money back after a bear market. So I guess the bottom line here is certainly that even though there have been fast recoveries in the past, the 2020 market set a couple of records. We've simply never seen such a steep and rapid bear market decline in the stock market, but we've also never seen such a quick recovery. It's unprecedented. And if you want to hear about more records, in 2020, the S&P has registered 10 of its 10 largest single session point declines. Although admittedly on a percentage loss basis, it doesn't look as dramatic. So I guess the question here is whether these extreme roller coaster rides, these ups and downs within a fairly short period of time, represent a new normal. Will both crashes and recoveries be much quicker in the future? So what I want to do here is consider two possible reasons for why the dynamics of bear markets might have structurally changed. So I would like to start with social media and maybe more generally technology enhancements. To me, it seems like social media platforms have had the effect that investors are increasingly short-term focused, short-term oriented. In the past, investors have checked the newspapers or the evening news to see how the stock market and individual stocks performed. It's hard to believe that before the internet, investors would actually have to call their stockbrokers to place orders to buy or sell stocks. But obviously the growth of social media has transformed how information is transmitted in the financial markets. Just consider how a single tweet of Elon Musk can change market values within seconds and wipe out or create billions of market value. For example, his tweets quite recently have influenced the stock price of the company CD Projekt, company that makes the game Cyberpunk 2077. He obviously influenced the GameStop stock. And Etsy stock, a $25 billion company, also soared 9% after he tweeted that he loves the platform. And obviously Elon Musk's Twitter account has also influenced the value of cryptocurrencies, such as Bitcoin or Dogecoin. So at least to me it seems like, due to social media, unnaturally high valuations of stocks like GameStop, AMC or BlackBerry seem to become more common, along with an increase in volatility. As Ben Carlson puts it in his essay on the future of bear markets, the repricing of assets happens faster than ever now that we all have the ability to trade, communicate and share opinions from the supercomputers that fit in the palm of our hands. It's like the speed limit on the markets just went from 35 miles per hour to 70 miles per hour. And not only do we have access to all sorts of information 24/7, no, moreover there are all sorts of influencers sharing information on blogs, YouTube, Twitter and podcasts, and who either knowingly try to move stock prices, which is illegal by the way, or they simply have a follower base that is just blindly buying or selling stocks the influencers talk about. And finally, I want to mention free trading platforms like Robinhood. I think these platforms certainly incentivize a high buying and selling frequency. And in a previous video of mine on the gamification of investing, I've made the point that these commission-free trading apps might actually be a net negative for retail investors and hurt their wealth building process. So I guess the bottom line here is that social media platforms might to some extent affect the price discovery mechanism of markets, at least in the short term. They tend to increase volatility and they tend to lead to a more speculative investor behavior. And thus I think it seems plausible that they will permanently alter the nature of bear markets. Alright, before I move on, if you want to support my channel, it would truly help me out a great deal if you just quickly hit the like button, or even better, leave a comment. This only takes you a few seconds, but it truly helps me to reach more people. Thank you. Another and second reason for a change in the nature of bear markets could be that the role of central banks, and the Federal Reserve in particular, has changed. In late December of 2020, the New York Times actually published an article titled "The Year the Fed Changed Forever." And they argued that the pandemic and the subsequent response of the Fed might have changed the identity of the Federal Reserve forever. As COVID-19 hit the US and all the other countries around the world, the Fed, so America's central bank, cut interest rates to near zero, and they began aggressively absorbing assets in an attempt to prevent another major financial crisis. Essentially, the stock market bottomed when the Fed announced it is going to use its financial bazooka. And that alone sent a pretty clear signal to the market. It convinced all of the, or most of the market participants that a major systemic risk, so the danger that the financial system as a whole would collapse, had been taken off the table. And Warren Buffett, he has been sitting on hundreds of billions of dollars for quite a while now. He's waiting for he was and is waiting for an economic storm that would allow him to deploy that cash pile when businesses are available at discount prices. In the past, his business conglomerate, Berkshire Hathaway, has been considered kind of a lender of last resort for troubled businesses that urgently needed liquidity to survive. But Buffett has actually pointed out that he simply didn't receive any calls from desperate CEOs in 2020. That's because the Fed acted so quickly and so decisively. During the 2008 financial crisis, for example, the Fed was much more reluctant and Buffett was able to scoop up stocks at bargain prices. But this time was different. So, you might be wondering why the Fed's action in 2020 might be relevant for the future of bear markets. Well, I would argue that the Fed's unconventional fiscal and monetary policies have set a precedent, a dangerous precedent. The precedent that the Fed would intervene in times of crisis, no matter what. So the Fed might set the precedent that businesses that are hurt by taking too much risk will be saved by the government, and that the Fed will do whatever it takes to save them. And as a result of this, businesses might be less risk averse, knowing that they have the backing of the central bank when the next economic downturn hits the country. And this might actually have the conflicting effect that there will be more instability, not stability. Moreover, the Fed action could have psychological implications on how investors view future bear markets. First, if investors can simply assume that the central bank will step in if things go south, this might make investors overly confident and induce risk-taking and lead to a more speculative investing behavior. It might also mean that during the next economic crisis, markets will recover much more quickly as they did in 2020. So the duration of crashes that lasted for many months or sometimes years in the past might be shorter in the future. Investors will be more likely to start buying stocks sooner, reducing the downward pressure on prices. So not only might bear markets last shorter, the decline might also be less steep. So instead of a severe bear market that lasts for, say, 20 months, and that comes with market declines of 40, 50, or even 60%, like we've experienced it in 2008. Future bear markets might actually only last 2 to 4 months, and investors would only witness crashes of 20, 25, or 30%. So near zero interest rates and excessive money printing might have completely changed the financial landscape. And to get back to Ben Carlson's essay, in his essay he wrote the following: "Stability itself can lead to instability because it causes investors to take even greater risks. This is especially true with elevated valuations and depressed interest rates. I don't think this is a scenario where recessions or bear markets are completely taken off the table. In fact, it could lead to more volatility in the markets, just in shorter bursts. Flash crashes and air pockets could develop that see stocks crash a large amount in a short period of time." And personally, I think Buffett has a similar view. Although he praised the Fed for its action to soften the impact of the coronavirus, he also said that it's hard to tell what the outcome of these easy money policies will be. And with that, I'm going to wrap it up here. The bottom line is that no one can really know if bear markets are changing forever. Saying that this time is different is a dangerous game to play. But I think there are actually convincing arguments to at least support the thesis that going forwards there will be more volatility, although bear markets might not decline as sharply as they did in the past. So as always, may your finances and investments prosper. Good luck.